one of the great things that I like about this job is that pretty much every time that I look at the major situation of what the economy is doing or what the stock market's doing, it's completely different than any other period that I've been doing it. And I've been doing this job for quite a while. And so today I want to talk about what's unique about the period beginning at the beginning of the pandemic back there in 2019, 2020, and why the market now is different than all the other previous periods that I've been through. So since I've been doing this. But to introduce this idea, I'll talk about a little bit of economic history. And the economic history is the difference between how economies usually perform in wartime and how they usually perform after wars are over. And I'm going to go way back to around about when Australia was first settled, and not long after that, something started in the 1790s called the Napoleonic Wars, and it went on until 1815. And what was one of the things about the Napoleonic Wars is that it was a boom. It was a terrific boom for anybody in the UK because there was a huge amount of government spending, and this spending was financed by selling debt. And that is to say, for a period of about 15 years, the British government was running big budget deficits, followed by the issue of debt. And by the time it got to the end of that period, of that stimulus, they had an awful lot of debt. And it took most of the next century to pay it all. But what was happening was you had this enormous boom because of these budget deficits. And what happened after the Napoleonic Wars is what normally happened is they stopped spending all this money, and this was followed by depressions. And that's kind of what happened in the First World War. That was the first big war for Australia to participate in. That there was a boom in stock markets in the US. I think British stock markets might have been closed, but the period of the war. But then after that, there was a kind of a tough period, but particularly in the UK and in Australia, because we tightened up a bit our monetary. After spending a lot of money generating a big boom in World War I, we tightened up after that, and that tightening in the US turned into the Great Depression of the 1930s. Anyway. What that really tells you is that you usually have big budget deficits running continuously during war times and big booms, and then it's immediately turned off in normal circumstances. You just don't have that in normal peace times. So what's incredibly unlikely and unusual about the period of history that we're living in is the US is running continuous wartime type deficits. That just doesn't happen ordinarily, and it hasn't happened previously since the 18th century, but it's happening now. And if I look at the IMF estimates for the size of budget deficits, of course, we know that in 2020, the US budget deficit blew out to its biggest since World War II, blew out to 14% of GDP, and then it fell in 2021 in the US to 11.6% of GDP. And that went back for just 1 year to normal levels. It went, the average long-term average deficit in the US is 3% of GDP, but in 2022 it fell to 3.7% of GDP. The only piece of normality in the recent history that we're living through. Because what happened after 2022 is, of course, Biden economics. And Biden economics is supported by two great pillars of huge deficit spending, as I've remarked before. One is the entirely inappropriately named Inflation Reduction Act, which is actually the Energy Transition Manufacturing Subsidy Act, which supports building windmills and solar farms and of course the building of the enormous requirement for transmission wire to link all those things up. And at the same time as that, the CHIPS Act, because of the rather important strategic need of moving the manufacture of chips, which up until very recently, 98% of all the chips made in the world are made in Taiwan, moving that back to the United States by providing enormous write-offs to anyone associated with the chips industry, of which a major company beneficiary of this is NVIDIA recently, which has had terrific earnings and generating terrific results for those people who own the stock. Now, what that does, if you're spending a lot of money and you generate a lot of profits for corporations, that affects the stock market by having an enormous impact on the US corporate risk premium. Because if US corporate profits are rising because of this government spending, well, they'll be issuing less debt, and if they issue less debt, then what happens is the yield on their corporate debt falls relative to sovereign debt, and you see these very low levels of the BAA spread that we've seen recently. Today, on the chart, I only updated this chart last week, and when I updated this chart last week, the level of the BAA spread had fallen to 1.49%. But that's old news. This morning, it's fallen to 1.4%. And these levels are, as I've said, lower than the spread that occurred at the lowest level of the boom, the stock market boom in 2007. And we're falling down towards the levels of the dot-com bubble of the 1990s, is where we are now. Now, of course, historically, there's been lower levels. And the lowest level was in the 1960s, when there actually was a war, and it was called the Vietnam War. And in the Vietnam War, even though most of the US was at peace, the Vietnam War, there was 500,000 men fighting a war in Vietnam, and that generated an enormous amount of spending, although not very big. The deficits weren't so large, but the corporate profits were enormous, given the size of the war. And that generated the all-time low of this series of only 0.3%. So even though we're falling to the lowest levels we've had this century, which is where we are right now in these spreads, there's historically been lower spreads. It's interesting just going back and looking at a little bit of history, since this is a very long historical chart. And so I'm saying that these very low spreads are normally associated with wartime. I actually went back and looked at the period of the 1940s, of the period of World War II, and what this beginning of World War II, the impact that it had on these corporate spreads. And at the beginning of World War II, in August 1939, the spread was 258 basis points. The long-term average of this spread is 2%. So it was above. Money was on the tight side in 1939, but with all the government spending, the spread fell to 77 basis points by the end of 1945. And of course, there was a big boom in stock markets. After the middle of 1940 anyway, there was a big boom in stock markets, and which benefited from these spreads. So why am I talking about all of this? Is that when I build a model of stock markets and I look at the two things that I used up until the middle of this century in the first 8 years of the century anyway, I used earnings per share and bond yield, and then we had this enormous blowout in these spreads, the financial crisis, and you can see it running very quickly between 2007 and 2008 up to 6%, and that was the highest yield and the tightest money since the Great Depression. And it was that which caused the Australian stock market to collapse in 2008, in spite of the fact that earnings in Australia were really quite good. The market collapsed anyway. And that was my lesson about the importance of including this in my model. And I've been able to use this recently to explain a lot of the market highs, the market high 2 years ago, and why the market is racing up now. So if you look at this and you're trying to think of this upside down, you can see this continuing fall in the spread. It means there's much more and more liquidity in both the US market and our market, and that's what's actually driving up the market, is this increasing liquidity, which you measure with this spread. You can see a little bit more closely if you look at what's been happening on the second slide, and we just cut this all down to the period since the beginning of the pandemic. And what we can see is when the pandemic first hits and the economies are shut down, there's a terrific run-up in the spread. So what actually happens is money tightens very, very rapidly. Now, if you kind of try and think back what was happening in 2020, the market fell out of the sky and it looked like it was going to fall forever. And there was, even though it wasn't publicised in the media, in 2020, we did have a global financial crisis, except it wasn't as severe as it was in 2008, but it was going to get as severe as it was in 2008 unless the central banks acted. And that's why the central banks acted so dramatically to cut rates and start buying an awful lot of debt through quantitative easing at the same time as cutting rates, because they didn't want a global financial crisis on top of the shutdown, okay? And that worked. It worked so successfully that the market started to rocket. And we never heard in the popular press, it never dawned on financial journalists that they'd actually lived through a major financial crisis. But it had been solved directly by the central banks. And it was that money, that aggressive action of the money, which saw this spread drop from 3.9%, which was the highest it had been since 2008, and in fact is around about the third highest it's been since about 1920, that this fell very, very dramatically to a level below 2%. And it was that which generated the enormous recovery in stock markets. We then saw the beginning of tightening by the Federal Reserve, and that generated some kind of, at least the spread retracted back to normal. But then what happened was the impact of quite amazingly large budget stimulus in the US. If I look at the budget stimulus expected this year, it's a deficit of 7.4% of GDP. And remember, the average deficit in the US is 3% of GDP over the full length and period of the data. After that, it's 7.45% of GDP, and after that, it's 7% of GDP. There's an incredible amount of stimulus continuously throwing year after year after year, and that's what keeps these spreads low, and that's what's driving the stock market up. So it's entirely liquidity that is keeping the stock market up, and will continue to drive it up. I think this is going to go at least until the end of next year. This market, driven by this liquidity and the stock market and these budget deficits, continue long beyond that. The only reason that I think it has a possibility of ending in the end of 2025 is because the tax cut legislation, which generated lower corporate tax levels in the US, ends at the end of December 2025. Of course, the government could change, but right now, that's as far as I can see. So what's happening is this is a very different market than anything else I've lived through. But what I can see is happening, and what I can included my models and proven my models is happening, is that these very big budget deficits generating very strong corporate profits, and that's generating a dramatic decline in corporate spreads. And it's that corporate spreads, when I put it in my model, which is driving this stock market up and should continue to drive it up until the end of next year.